Hello, this is Steve Malone with Compass of X. Hope you're doing well today and again some good trades. Don't catch a runaway train at the top of the hill. As an active trader, I often see the market make these very strong moves after the market's been stifling in a choppy market situation based on some sort of news event or some economic event. Today we had the FOMC meeting just released their minutes. And in their minutes, there's sort of this quantitative easing by which they're going to maintain low interest rates for an extended period of time into 2014. Well, on this news, the market across the board dumped the dollar and moved right into riskier assets like the Aussie dollar, the Euro dollar, the pound dollar, going even into the Swiss franc. As strong as the franc is, the Swiss National Bank not wanting it to get any stronger. However, that's what took place. And oftentimes when a report like this comes out and traders happen to miss the moment of entry, like the train has left the station, we're trying to catch up to the train, the interesting thing I find sometimes that active traders keep seeing the market push up, and push up. Well, I've got to get on. Well, hold on. Let me see if it'll pull back. Well, it's not pulling back. Well, let me get in. Hold on. And then finally they decide to get into the trade. And by the time they get into the trade, it starts falling back on them. And they find themselves upside down by buying in at the wrong time. Avoid jumping on a runaway train near the top of the hill. Well, the question is, well, Dean, how do you know where the top of the hill is? Well, there's a very simple technique when you're watching the market make these runaway moves where you can determine where the market potentially is going. And this is a technique that I use in my active trade room. I do it all the time. You can do this to determine potential targets. You can also do this technique to determine where the market may go. Now, one caveat is to always look back in time and look for any other support level or resistance level, in this case a resistance level where the euro dollar might have gone up to before. But let me show you this, real simple to do. You simply take your Fibonacci retracement tool and you're going to run it more or less from the swing high to the swing low. Okay? Now, as the market is driving to the upside here, it's really climbing higher and higher and higher. What we're looking for is at what level will the market move to. Let me move this over just a bit so you can see this a little bit easier here. So here's our swing high to swing low. And so as the market is pushing higher and higher, what we're looking for is at what level is the market going to. Well, when the market starts getting up to the 127.2, the 141.4, start to look for a potential retrace. Start to look for this to get back to the downside. Now what I look for is if the runaway train gets going here, and this is pushing, driving real hard, what we want to do is we want to try to get on this when it's breaking in this area right here. But if it's up above the 100% level and doesn't seem to want to come back and test it, and it's already pushing up in this area, my suggestion is avoid getting in up here because you are buying near the top. And what the suggestion is to let it fall back over. Better yet, take a look at the Trader's Dynamic Index. The Trader's Dynamic Index, when you have that green line way up high here, you can see the green line's up here near the 90 mark, and you have it outside the blue volatility band to the upside. When it starts turning over like that and starts breaking, the green line breaking the blue, breaking underneath the red, right in this area, right in that area, there's a potential here to actually sell and catch the move back down towards the 100%. This is all based upon the previous swing high to swing low. And you catch a little bit of the move back down. And if you take it a step further, run the fibs based upon this move just to see what the retracement is. From the low point, run that up to the high of the move, run this back to the low point, and you can see a potential take at the 23.6. That would be the sell. That would be the direction, the potential for the sell, and maybe a push down to the 38.2. And you can see in this case, the market had not pushed down to the 38.2, but instead had pushed back up to the 23.6. So let's do this one more time over here. Take a look at the Aussie dollar. Again, we had a swing high to a swing low. So simply take my fibs from the swing high to the swing low. Again, I'll move this over just a bit so you can see it a little bit easier. But you can see from the swing high we had back here to the swing low, you can see that it made a move all the way up to the 1618. Now, this is a bit different in the situation over here where if I flip this back around the way it was, in the euro dollar, we only went up to the 141.4, and then I had 3 lower highs showing me a potential turn. In this case, we continue to get higher highs. And then we start to see 3 lower highs. Be careful too when you have a high, a higher high, and then this shows a higher high than the previous one over here. Okay? What's preferred to catch is 3 lower highs or a swing high by which you have a high, a higher high, and then a lower high of this high. Okay? That's a swing high. But the same thing applies. Avoid buying near the top. Avoid jumping on this runaway train as it's about to take its move to the downside. And in the case of the Aussie dollar, if I zoom in just a bit here and flip this around, let's just see what the retracement was. Okay, there we go. And I'll zoom back in. Look at that, right to the 23.6. So you could catch part of that move to the downside, and there's still, even if you didn't get right at the top, there's the potential to get 10 to 20 pips just in that retracement. Again, look at the TDI, way up high. We get this hook effect back over, crossing the blue volatility band, below the red trade signal line. This is that potential trade. Now, this is counter trend with the market moving up, but what we're simply doing here is avoid entering into a long position when the long is near the high, waiting patiently for the setup for it to potentially drop to the downside. Well, folks, this is Demon Alone with Compass FX. I hope some of the information here about avoiding jumping on the runaway train near the top of the hill will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.